The direction, or in other words, the bias of price is arguably the most important, because knowing the bias allows you to know what the next target in price is. And when you know the next target, so your bias is very clear, then it makes it a lot easier to profit from that. So the way you can see that is that the bias essentially is the foundation. Everything else, like for example an entry, is built on top of that foundation. Now if the foundation is weak, then the entry might be weak and the entry might also fall, resulting into more losses. So the bias, understanding the next target, is crucial. Now in this video, I'm extremely confident that if you follow along with the full video, you are going to absolutely master the bias. And this is going to be our roadmap towards achieving the goal of mastering the bias. First of all, we are going to go over what is price moving towards. Second of all, we're going to go over the specific rules. And number 3, we have knowing the bias. Number 4 is arguably one of the most important, is when do you switch bias? So when are we looking at a reversal in our bias? Then last but not least, of course, how can we profit from it? So when to look for an entry. So step number 1, what is price moving towards? Now, before we dive into those technicals in just a second, you should really understand the following. I've personally always quite disliked how subjective trading can be. So in my opinion, there always needs to be some form of objective guidelines. I always use the 80-20 rule. 80% of the trading plan should somewhat be objective. 20% can potentially be subjective. So that's why the way we determine our bias, and also what we're going to discuss in this video, is for the most part completely objective. Because for me, objectivity leads to clarity. When something is clearly defined, we are far more likely to be on the exact same page of understanding. Think of it like a language. If I, for example, land in Brazil, I don't speak a word Portuguese. So I could start blaming everyone around me that they're not making any sense. Or I can realize I just don't know the definition of the words they are using yet, their language. So it's important to realize that what we're going to do is not rocket science. You're just going to learn a language and the specific words that we're using to determine how you can get to a certain bias, how you can get to a certain target. And that leads us to step number 1, because what is price moving towards? Now, the objective definition, price is always moving towards a PD ray. That's it. So the target in price, so what price is moving towards, is always going to be a PD ray. But it's our job to figure out which PD ray we are moving towards next. Now, first, of course, let's not get ahead of ourselves. We're going to dive into that in some later steps. But first, we should then understand what is a PD ray, or what are the PD rays that we are talking about. So let's quickly go over the PD rays again. First of all, of course, we have a fair value gap. I think most of us by now know what a fair value gap is. It's a 3-candle pattern. You have the first candle doing whatever, the second candle right here is a body closure above the first candle high. And because it's a body closure above the first candle high, it leaves this body part right here. Then once the third candle closes, does not trade back into the first candle high right there. Then we have this 3-candle pattern. And this 3-candle pattern right here is a fair value gap. So this is a bullish fair value gap, and this is a bearish fair value gap. Again, like I mentioned, I think most of us have a good idea of what a fair value gap is, but most of us don't know the specific rules that we use for fair value gaps, which is exactly something we're going to dive into in the next step, which is very interesting in my opinion. But before we go over that, of course, we have 2 more PD rays. So the second type of PD ray that we have is swing points, and swing points are swing highs and swing lows. So it's also a 3-candle pattern. This right here is a swing high. The first candle right here, second candle, sticks out with a wick at the top right there. And the third candle, once the third candle closes, does not trade back above the second candle high right there. Then this is a swing high. Same, for example, that this is a swing low right here, where it's inversed and instead the wick in the middle is sticking out at the bottom. So this, for example, right here at this moment in time is a swing high right there. Now for these swing points, there are also specific rules. But again, let's first understand, what is the third PD ray? The third PD ray is a fair value area. A fair value area, simply said, and all you should know for now, is that it's essentially the retracement before we continued higher. So price moves similar to these swings. You have a swing higher, you have a swing lower, and you have a swing higher again. The swing from this point to that point right there, that's the fair value area. So this right here is the fair value area right here that we can retrace back into to potentially continue higher from. So for example, this right here is also a fair value area sitting right here. Then this right here is also a fair value area right there. Now, what you should know is that I'm marking out the bodies right here of the fair value area. And in this case, I'm marking out the wick. When the wick, so the highest point of the fair value area, is exactly overlapping with a fair value gap right there, you mark out the wick. If that's not the case, so for example, right here, the highest point of the fair value area is not directly overlapping with a fair value gap to the right, and this is on the same time frame, then what you do instead, you mark out the highest bodies right there of the fair value area instead. That's going to be the sensitive area instead. Now, when we start marking out these PD rays, so we have this fair value area, we also have this larger fair value area sitting right here. Now, the fact that a fair value area is simply, again, the retracement right here before we continue lower, that's all you should know for now about the fair value area. We're going to dive a little bit deeper into it later on, and then everything is going to click as well. But when we mark out this fair value area, and we, for example, also mark out this fair value area, and we mark out, for example, all the closest PD rays that we have right here, then you'll see a story is starting to unfold. And that story is essentially that we are constantly moving towards those PD rays right there. And again, our job is then to figure out, how do we know what, so for example, right here, how do we know what the next PD ray is that we are going to target? Is it going to be this swing low right here? Or is it going to be this swing high right there? And of course, if we know that, then we know the next target. And if we know the next target, it becomes, again, like we mentioned, easier to profit from it. But in order to know that, we first need to go over the specific rules. So step number 2, because every PD ray that we have mentioned right here has specific rules to them. Let's start off with the fair value gap. The fair value gap has essentially 2 rules. And that is that you should know the fair value gap can only have one sting into it right there before it's mitigated. So before it's used up. The tiniest sting. So this right here is a fair value gap. We have a sting into that right there. So we retrace back into it. That means it's used up. So you can't use this in the future anymore. Similar to this fair value gap right here. When we have this sting into this fair value gap right there, that means now the fair value gap has been used up. We try to push higher from it, fail to do so. So don't drag it towards the right there and think this is going to act as some sort of support area in the future. No, because then it becomes very random. You're going to lose a lot of accuracy. Don't mark out the 50% line or anything like that. No, we're not going to use random lines. So instead, what we want to do is when we fail to continue higher from this fair value gap, for example, right there, we are leaving something behind. And what we are leaving behind is a PD ray within that fair value gap right there. So in this case, it's going to be this swing low right there. Now that swing low is potentially what we can continue higher from. And it's the same, for example, right here, when we fail to continue lower from this fair value gap. So right here, and we see a bigger retracement. Now the bigger retracement, again, the fair value gap is not relevant anymore because that's been used up. But instead, what is relevant is, for example, the fair value area that we have a sting back into. And that fair value area is then what we can potentially continue lower from instead. The first very important rule to understand, because if you don't apply that, you're going to be essentially all over the place and you're just going to be trading random levels. Now, before diving into the second rule of the fair value gap and the other rules of the PD rays, you should understand the following. That fair value gap leads to the understanding of candle signs. So what do I mean by that? Is, for example, right here on this time frame, we have this bearish fair value gap and we also have this bullish fair value gap sitting right here. And we have a couple of more fair value gaps and we even have a couple of more fair value gaps. But the point that I'm trying to make right here is that these fair value gaps on the 4-hour time frame, if you zoom out to the daily time frame, they turn into a singular candle. So for example, right here, if we replay it a little bit and we look at this daily candle right here, that daily candle has a long wick at the top. Now this long wick, what is that? If you go into, for example, the 1-hour time frame, it's simply said fair value gaps going higher and fair value gaps going lower. So these fair value gaps, they always give us an idea of what the direction or what the bias is in price. And these fair value gaps can be looked at through one time frame. So for example, here you also have daily fair value gaps to continue higher, but those same fair value gaps turn into a singular candle if you now go up in time frames. And that's exactly what candle science is. So candle science is the understanding of what the next candle wants to do based on the previous candle's close. And the reason we can, for example, understand that we have this candle being a large wick right there, and because that candle is a large wick at the top, that tells us on the lower time frame we saw bullish fair value gaps and then bearish fair value gaps. In other words, a reversal. So the next candle can potentially be a down candle, a bearish candle right there. Now you can already see how strong that is, because for example, at that moment in time, the target would have been this weekly fair value gap, which was also our target. Now that understanding of candle science, so understanding that a singular candle is also fair value gaps, it's just a different time frame, that leads to the understanding of two candle rejection. So if we go back to the 4-hour time frame right here, then every time we have a sting into any PD rate, so that's going to be a fair value gap, that's going to be a swing high, swing low, or a fair value area, doesn't matter, any type of PD rate. On the same time frame right here, what you'll see most likely is that the first candle right here is already going to be a rejection. Then the next few candles, and that's the rule of every PD rate that we have, when we trade back into a PD rate, the goal of price action is to create a new fair value gap as soon as possible. So for example, right here, when we trade back into this fair value gap right there, we create this new expansion right here, and we create quite fast already a new fair value gap to continue higher. So from any PD rate, either the first candle right here, like we see, is going to create a rejection. And like we, for example, right here also see, even if this fair value gap doesn't hold right there, that's still very good knowledge, because this right here is where we were rejecting, also with the first candle. Same, for example, with this fair value gap, also the first candle is a rejection right there. Now, in some cases, and the name is two candle rejection. So why is it two candle rejection or one candle rejection? Is because if the first candle is not a clear rejection, so not the long wick we see, for example, then the second candle can still sweep right here, the previous candle low right there, to then continue higher. Now, whether it's the first candle or the second candle creating this long wick right there to then create the rejection, the reason why we are talking about this and the reason why this is quite crucial to understand, because that exactly gives you the understanding when a certain PD rate is, for example, failing. So what do you notice with the PD rates that we have marked out so far? So we have this fair value area, for example, right there. We also have this fair value gap right there. We have this swing low, and most recently we also have this swing high, and we have this fair value area sitting right there. All of them have something in common, and that is that either the first candle or the second candle is creating the rejection, and that gives us a very good idea of what we are respecting. So for example, the reason why I said this right here is still important to understand, even if it doesn't hold right there, is because two candle rejection tells you what should happen. So if we are going to continue lower right there, then the first candle is a rejection, the second candle should continue lower right there. Perfect. What ends up happening instead is that we instead have two candle rejection from the swing low right there. When we create two candle rejection, we're going to have a rejection high. So this right here is the rejection high, the two candle rejection that we saw from the fair value gap. Now stick with me, it's going to click, all of it, I promise. The moment where we run this rejection high right there, we have now essentially disrespected this fair value gap. So that fair value gap right there is not relevant anymore. So instead, what we see is we see this deeper retracement, and that deeper retracement leads to this fair value area eventually right there. And that fair value area is what we do respect right there to continue lower instead. This understanding is going to be very helpful for what we are just about to talk about in just a second. Okay, so we were talking about these specific rules, right? Fair value gap can only be used once, and from every PD rate, so also from fair value gaps, we expect new fair value gaps to be created. Now we move on to the next specific rule, and that is for swing points. So when we have, for example, a swing high right here, there's two things that can happen. Either we are going to sweep that swing high, or we are going to run it. Now, running a swing point looks something like this. So for example, we have this swing low right there, and we drag it out towards the right. When we run that swing low, that essentially means that when we reach this low right here, we can expect price to continue lower even. But if we, for example, sweep a swing low, that means once we reach the swing low right here, we expect it to reverse. Now, you'll notice something very specific, because in order for us to tell us if we are sweeping or running swing high or swing low, then we need to understand a fair value area, because this right here, when we reach below this swing low right there, what does that turn into? Most of the time, I would argue 9 out of 10 times, when we reach below a swing low or above a swing high, that turns into a fair value area. So the fact that we trade below this swing low right here, that swing low, the exact swing low, turns into the fair value area right there that we might want to continue lower from. So the fair value area, if we respect that right there with that wick, then that tells us that we are running the liquidity and we can continue lower. Where on the opposite side, when we are sweeping a swing low right here, we also have this fair value area right there. But that fair value area is not getting respected and instead getting disrespected to continue higher. Now, this is where the story is now all going to tie in together beautifully, in my opinion, because that leads us to the following. We need to understand a little bit better what a fair value area actually is and how it operates. The reason why it's called a fair value area is because the market uses these 3 swings. So for example, the bearish fair value area has 3 swings. We have 1, 2, and we have 3 right there. Or one you might also see very commonly is a bullish fair value area that has 1, 2, 3. Again, the retracements that we see, this right here is the fair value area. The reason why that is because the first move that we have higher right there, that offers buyers a fair chance to get involved. Now, the market moves a little bit too fast right there. Since the market moves too fast right there, it's going to also offer sellers a fair chance to get involved. So what the market does is buyers get a fair chance. Now moves too fast. It needs to create a retracement. So sellers right here also get a fair chance to get involved. And then it continues higher again. Now, when it continues higher again right here, we have this area, that retracement that we've made. This is where both buyers towards the left and towards the right and sellers right here in the middle got a fair chance to get involved. Now you'll notice that same pattern repeats above this high right here, because this high, above that high, only buyers got a fair chance to get involved right there. So that means the furthest that we can potentially retrace is back towards the high right there, towards the fair value area, to then continue higher from it again. So that's why you see this great accuracy with, for example, this fair value area right here, where we have 1, 2, and 3 right there. We have those 3 swings where this becomes the fair value area, and that exact low is how far we can retrace before continuing lower. Because below this low, and to be specific, this gray box, this area is the only area where we have not offered fair value just yet. So that's how far we can retrace to then continue lower. Now, why is that? Because the market is always doing one of 2 things. So you consistently know what the market is doing by understanding this. The market is always either offering fair value or it's seeking liquidity. That's it. So for example, with this retracement back into this fair value area to then continue lower, what did the market just do? It just offered fair value to then continue lower again at the fair value area. But what did the market do with this fair value area sitting right here? Well, with this fair value area, it went a little bit different. And this is where, again, the 2-candle rejection comes in. Because we offer fair value, and you know when the market has stopped offering fair value is when the 2-candle rejection has now a rejection high or rejection low. So what I mean by that is when you have this bearish fair value area right here. This right here is the rejection high from this bearish fair value area. So that means this right here is according to the rules that we had, where the first candle is a rejection. So the second candle, third candle should just keep on continuing lower, right? That's the rules we have. And the reason we have those rules is because that allows us to understand exactly what should happen when that's not the case. So what I want you to understand, zoom out a little bit, because we're setting up frameworks. We're setting if X happens, Y should happen. If Y happens, X should happen. So right here with this fair value area right there, we offer fair value at this moment in time right here. And we have, again, the 2-candle rejection where the first candle is actually not a rejection, sweeps the previous candle high, where the second candle right there becomes the rejection high right there that we can potentially continue lower. So according to the rules, where from every PD ray, we should now create a new fair value gap as soon as possible. This third candle should ideally be a new expansion phase candle. Then we create a new bearish fair value gap, etc. to continue lower if we want to continue lower. But if that does not happen, and instead we run right here the rejection high, then that means we are now not offering fair value anymore. We are instead seeking liquidity. And this is where the next part comes in. Because when we talk about price action, we talk about lags. More specifically, we talk about order flow lags. Now, this was actually not a planned topic right here for the video, but it's very important to understand. You'll notice something in price action. And what you'll notice is that price action has lags. And what are lags again? Lags are swing lows, for example, followed by fair value gaps right there. So this is a bullish order flow lag right there. Now this is a bearish order flow lag right here, where we have a swing high. That swing high right there is followed by a bearish fair value gap. The way the market operates a lot of times is that it simply follows these order flow lags. This is arguably the easiest thing you could do if you want to get to a bias, is simply following the order flow lags. But there are nuances to it. So that's why it's not just, hey, just follow the order flow lags. There you have your bias, there you have your target, go and trade. No, because there's more context needed. So for example, what we'll see right here is that we create bullish order flow lags right there. These bullish order flow lags hold for a while. Then we create bearish order flow lags right there. So then again, bullish order flow lags. Once those bullish order flow lags fail again, we start to continue lower, and these bearish order flow lags right here start to follow through and follow through and follow through. But then eventually we start to fail these bearish order flow lags right there and start to create these new bullish order flow lags right there. Why? Again, we're looking at one time frame. We need to have an overview of more time frames right here. So what are we currently in? Well, we are currently still in a bullish weekly order flow lag that we might want to continue higher from. Now, the reason why this works quite well is because order flow lags have a higher probability of holding. So for example, when you have a lag right here, a swing low that doesn't have a fair value gap higher right there, and that means it's quite low probability. It might get taken out right there. But if you have these order flow lags, so this right here is an order flow lag, then it's very likely we retrace back into the order flow lag to then continue lower again. And this is an order flow lag, we retrace back into it to continue lower. This right here is also an order flow lag where we have this order flow lag right there. Then this right here, from this order flow lag, we don't create a new order flow lag. So we actually right here don't create a new fair value gap. So what happens instead is that we create this new bullish order flow lags instead right here that we potentially can continue higher from again. Again, you're just following the order flow lags essentially, because those order flow lags have a high probability of holding, again, of holding towards one side of the market. So creating a new order flow lag in the same direction. But again, like we mentioned, there's nuances to that, because we can't just end the video on that. We also need to understand right here what actually specifically happens with, for example, this bearish order flow lag. Yes, we now understand, okay, if we are not offering fair value here anymore and we see, okay, we have the token rejection, we have the rejection high. If we take that out, we're not offering fair value anymore. So instead, what are we doing? We are seeking liquidity right there at the top, because the market is always either offering fair value or it's again seeking liquidity. Now we can define an order flow lag a little bit more, because an order flow lag has three elements. Surprise, surprise, it has all three PD rays. What does this bearish order flow lag right here have? And let me just use the replay tool to focus your eye on this order flow lag. Because this bearish order flow lag has the swing high, that's the first PD ray that we talked about. Then the second, we have, of course, also the fair value gap. Without a fair value gap, there is no order flow lag. So without a fair value gap, I need you to understand there's also no fair value area. So when we have the swing high, we have the fair value gap, we have an order flow lag, and that means we also have right here a fair value area. These three different PD rays right here can be split up into their own category. So what you'll usually have, and in this example right here, I'm using this fair value area just for the example's sake right here. I know I used this one towards the left a little bit more right there. I'm just going to use this one for the example. Right here, if we are going to retrace, how far can we retrace? Well, you have this fair value gap that we can potentially continue lower from. You also have the fair value area that we can also potentially continue lower from. You could argue you also have the swing high that we could also potentially continue lower from. Now that's too vague. That's a little bit all over the place. Then it becomes very random, right? We need to have a very good guess. How far can we actually retrace? This is where float, odd, and lot comes in. This is quite an old quote unquote old concept that I introduced to YouTube as well, which is quite some time ago, but it still stands so true to this day, because an order flow lag consists of float, odd, and lot. You have float, which is the first line of defense. So if price is going to retrace, you need to identify what is the first PD ray that price is going to retrace back into to potentially continue lower from, which in this case is this fair value gap right there. So that right there is the first line of defense. In other words, is the first area that we might want to continue lower from. Then you have the odd, which is the overlapping defense. The overlapping defense is ideally going to be the fair value area right there. And then the overlapping defense is also, again, what we can potentially trade back into to then continue lower from right there. Now, this is where it becomes interesting because the lot is actually, so the lot stands for last line of defense. The last line of defense is always going to be the swing high or swing low of that specific order flow leg. The last line of defense is not something we can continue lower from. It becomes the target when the overlapping defense fails. So let me explain this a little bit more clearly as well. The overlapping defense is the fair value area right there. If the overlapping defense right there fails, then the last line of defense right there, that becomes the target. So what are we doing at that moment in time? Essentially, we have tried to offer fair value. We failed to do so. So instead, we are seeking liquidity. So that's, for example, what happens right here. When we have this bullish fair value area initially right there, you'll notice a specific pattern, which is very interesting because we first tried to continue higher from this fair value gap where we have this rejection low right here. This rejection low gets ran. When this rejection low gets ran, that means the first fair value gap of the complete order flow leg has failed. So the first line of defense right there is failing. When the first line of defense is failing, the overlapping defense is what we can now potentially continue higher from. If this happens on the higher time frame, then what happens is that this right here is already a very clear area where you can target, right? Because the first line of defense failing right there, then the overlapping defense becomes the target. Now, when we then sting into the overlapping defense right here, the overlapping defense is what we try to offer for value right there. Eventually, we fail to offer value and we start to continue lower. So the overlapping defense also starts to now fail. And because the overlapping defense starts to fail, the last line of defense right there becomes the target. This is all great, Arjo. This is beautiful in hindsight. I get that comment quite a lot. This is all beautiful in hindsight. I need you to understand, everything here was already called before it happened. So there was a specific video made on this specific scenario right here, where it was around there, right there. I'll link it in the description, where this played out exactly what we expected to happen right there. Just why? We're not geniuses, and I'm not here just guessing on what can potentially happen. This is objective things, and if these objective things align, it gives you a lot of clarity, but it gives you the probability of what should happen in a market, and that's important to understand. So again, in this bearish scenario right there, what happens? The overlapping defense right there fails, so the last line defense eventually becomes the target, and instead we start to continue higher. Now at this moment in time, what do we have? We have a similar scenario, right? We have this overlapping defense right here. We have the first line of defense sitting right there as well. So the overlapping defense, this is going to be sort of the moment of truth, is what we can potentially continue higher from right there. If we try to instead start to create these bearish value gaps, we might want to start to continue lower again. That's the exact same what happens with, for example, this bullish fair value area right there. Now, and this finally leads us to step number 3, knowing the bias. In knowing the bias right here, we're going to mainly talk about arguments and also probabilities, which is again very interesting in my opinion, but I need you to understand first that trading is all about probabilities. So nothing that we talk about right here is a given. Now, we understand that we have certain rules of what should happen. The reason why it should happen is because when it doesn't happen, then we know what should happen afterwards. So again, it's sort of this framework where if X happens, you do Y. If Y happens, you do X. So what we are consistently doing and what we are going to do is we're stacking up arguments, and those arguments give us a probability of what is likely to happen in the market. So for example, we might be 80% bullish at this moment in time, and you can actually calculate that percentage-wise, which is what we also do in the MMT, to then understand, hey, are we more likely to continue higher or more likely to continue lower at this moment in time? What are the probabilities? Nothing is 100% given in the market. Very important to understand. So the way we know the bias is, again, we know that the market is always moving towards PD ray. It is now our job to figure out which PD ray is next. And the way you know which PD ray is next is by stacking up arguments. So the way I want you to see this first is, I love using this analogy, and it's when you're sitting in a courtroom, be the judge. So you are the judge right there. Then you have a bullish side and you have a bearish side, and they're both giving their objective arguments to you. And then based on those arguments, you need to determine, okay, well, this is the probability what I think that this person is correct or this side is correct. So for example, if the bullish side gives you 5 arguments and the bearish side gives you 0 arguments, well, then the bullish side is most likely the correct side. So we're more likely to be bullish at that moment in time. Okay, that's all fun. But then what are arguments? Arguments are suggestions. So what might happen in the market? And this is where step number 2, the specific rules come in that we just talked about. And that's why the specific rules, that was quite a long list right there. But if you understand those different things, then you understand the different arguments, and you can then understand based on those arguments what the bias is in price. So for example, a bullish fair value gap right here, this is a suggestion. Why is that a suggestion? Because we understand a bullish order flow lag right here has that bullish fair value gap. And since it's a bullish order flow lag, it's quite likely, it's already higher probability that it just has a retracement back into it to then continue higher from it, like we saw in those earlier examples. Now that's a suggestion based on the rules that we have. So that's an argument that we have. So at this moment in time, an argument that we have is, well, we have a bullish order flow lag. But on the other side, we also have this swing high right there. And that swing high is currently getting respected and potentially swept because we have this long wick right there at the top. That's also a suggestion. Now that's a bearish suggestion, so that it suggests that we might want to continue lower instead, and we might be sweeping that to continue lower. So these PDAs, for example, either this right here might be the next target, or this right there might be the next target. These PDAs not only tell us what the target actually is right there, it also tells us right there the arguments that we have. So the arguments that we have towards potentially being bullish or to potentially being bearish. And this is again where the understanding of a trend somewhat comes in. And you really, to understand arguments a little bit better, you need to understand if we are still respecting or disrespecting certain PDAs. So let me explain that a little bit more clear. A bullish trend is, simply said, disrespecting premium raise and respecting discount raise. A bearish trend, so if we are continuing lower, what are we doing? We are disrespecting discount raise and we are respecting premium raise. If we are respecting certain PDAs or we are disrespecting certain PDAs, that's told through 2 candle rejection. So for example, this swing high is currently getting respected. Why is that swing high right there getting respected? Because 2 candle rejection right here is still intact. So for example, this is currently the rejection high from that swing high. If we take out this rejection high right there, then we can confidently say, well, we are not respecting the swing high anymore. And the same way right here, what we saw, for example, with this fair value area, when we have a sting into that fair value area and 2 candle rejection, but the first candle was not a rejection, but the second candle right there is a rejection, then as long as 2 candle rejection is still intact, so within the rules, either the first candle is a rejection or the second candle is a rejection, and the rejection high or rejection low is not getting taken out, is not getting ran at this moment in time, and that means we are still respecting the PDA right there. So for example, the fair value area is currently getting respected. But if we now run this high, which is the rejection high based on 2 candle rejection again, and that means we are now disrespecting that fair value area. And that is a bearish fair value area, so that's a premium array. So this can be applied the same, for example, to this fair value area. This fair value area right there was getting respected and still is getting respected. But for example, this fair value gap, that fair value gap was getting disrespected because we run the rejection high right there. But that does not mean we immediately switch bullish right there, because the overlapping defense, the fair value area right there, overall still bearish, and we always respect that to simply continue lower still. So if we now go back to the most recent situation that we have sitting right here, we currently are in quite an interesting situation because we are respecting a premium rate, which is that swing high, but we could potentially also be bullish because we might be respecting right here this bullish fair value area. Now, we're not too sure when the rejection low or what the rejection low here is going to be just yet, but based on that, we have 2 opposing arguments, because we have the bearish argument right there of respecting that premium rate, but we also have the bullish argument of potentially respecting the discount rates, so the fair value areas. And of course, if we stack up those arguments, then that means you have an argument for the bullish and the bearish side. So that means at that moment in time, if you were to calculate that, that's 50-50. That's 50% towards both sides of the market. So at that moment in time, that's not interesting. The probabilities are not necessarily in your favor to look to try to get involved right there. So when we create, for example, this rejection low right here, and we have this rejection high right there, we disrespect the swing high right there. If we run this high and we disrespect the discount rate, so the fair value area, if we run this low right here with those new fair value gaps going higher or new fair value gaps going lower right there. So if we run this low, we take away the bullish argument. But if we run this high, we have now taken away the bearish argument. And that right there, that's going to be interesting because then we have a very clear bias, a very clear target. Now, this is where I want to now go from euro US dollar to gold right here, still on the 4-hour time frame as well. This is very important to understand, this next part, because now, of course, we need to tie it in together and really understand, okay, well, how can we then clearly get to that bias right there? Right here, we are looking at gold, and I'm going to use the replay tool again. We have this weekly fair value gap right there. That weekly fair value gap, again, the weekly order flow lag that we have bullish right there, that in itself is already a potential argument. That is that price is potentially suggesting that we might want to continue higher. But if we now go down time frames and we go into the 4-hour, for example, then on the 4-hour, we see that whilst we are continuing lower, so we are retracing back into the weekly fair value gap right here, we are creating this bearish fair value area. And to be specific, that's this 4-hour bearish fair value area sitting right here. Now, of course, we have a weekly bullish fair value gap and we have a bearish 4-hour fair value area that we might want to continue lower from right there. At first instance, and if you've been following me for some time, you know the stronger or the higher the time frame, the stronger the time frame. So for example, what I mean by that is that the weekly time frame right here is stronger. So if the weekly time frame is a higher time frame and it's a stronger time frame right there, then in theory that should mean as well that we already are more likely to continue higher right there. And you can have that suspicion, that's perfectly fine. But that suspicion needs to be backed up by some evidence. So what I mean by that is this overall, this bearish fair value area is suggesting that we might want to continue lower instead. So if this is suggesting that we might want to continue lower instead, we should, what should we do? Ideally, have the overlapping defense, so the fair value area failing right there. And if the fair value area is failing, is getting disrespected, that means the last line of defense is going to eventually become the target. And if we run this high, then eventually the all-time high right there might become the target. So what we are doing is we're taking away opposing arguments. And when those opposing arguments are taken away, that's exactly when we look to potentially get involved. So for example, right here, we currently have the 2 candle rejection into the bearish fair value area right there. And the rejection high is then this high right there. Now, from that rejection high, if we run it right there, we are now disrespecting the fair value area right here to potentially continue higher. And we can also potentially continue lower right there instead. And if we, for example, were to run this low right there, then we would have the opposite, where this weekly fair value gap is now getting disrespected to continue lower instead. So actually, when you open this chart right here, this area in the middle is not where you want to get involved because you have both bearish and bullish arguments at that moment in time. So right here, once we start running that rejection high right there, then what happens is we are now disrespecting this fair value area right there. It's not following through lower anymore. It's not offering fair value. We're now seeking liquidity at the top right there. In other words, the overlapping defense is also now failing. So this right here gives us a brief moment where we really only have bullish arguments because the only bearish argument that we had is now taken away. And because the only bearish argument that we had is taken away and we are only left with bullish arguments, this makes it extremely high probability right there to look for an entry to continue higher towards these next PD rays, which are these next swing highs. Those become the target. Same right here. As long as we are disrespecting these premium rays right here, so the 2 candle rejection right here is also failing from that swing high. So there's no bearish argument to be made at this moment in time. In other words, the next target, this fair value gap right there, the next PD ray, that becomes the target. So on the 1 hour, for example, on the 1 hour right there, when you have this new order flow lag, that right there is very interesting to look to get involved to now continue higher towards that next target. Now, the way you go about this in your top-down analysis is something we're going to go over in a little second as well. But first, I need you to understand the following, and that is step number 4, is when do you switch bias? This is where most traders go wrong. And from my experience, I've also gone very wrong right here because most traders, they go from bullish, bearish, bearish, bullish. They are impulsively switching between their bias. So what happens then is that you might take a buy, then a short, and then buy again. This is not what you want to do. you want to determine, and that's again, we're going to do a top-down analysis in just a bit, but you want to determine, okay, what is your higher time frame bias, first of all. Based on that bias, you're going to stick to that. So if that might be bullish, and in this case, that was also bullish right here on gold. And what might happen is that all of a sudden, when you have a bullish bias, boom, something like this happens, where you get a large bearish momentum right there going against you. So all of a sudden, you get a bearish argument, again, in price. When you get a bearish argument right there in price, because all of a sudden we create this bearish fair value gap, for example, this is not where you immediately start switching bullish, bearish, bearish, bullish. So the same, for example, on what we talked about EU. No, instead what you do is you were bullish before that bearish argument entered the market right there. So what you do is you don't go from bullish to bearish, you go from bullish to 50-50. From 50-50, you might go to bullish again or to potentially bearish eventually. This is extremely important because this is going to protect you from a lot of losses, essentially, from unnecessary losses. So when you are bullish and right here, a bearish argument is now all of a sudden in the market, you go from bullish 50-50. And depending on what happens next, so if the bullish arguments get taken away, you become bearish. If the bearish arguments get taken away, you become bullish again. So right here, ideally, of course, we see the bearish argument gets taken away to continue higher again, because that was our initial bias, which is important. So right here, from this bearish fair value gap right there, we have the 2 candle rejection high. Again, do we understand by now how we are disrespecting these PD rays? When is a fair value gap failing? When is a PD ray failing? Yes, because that's based again on 2 candle rejection. So the first candle right here stings into that fair value gap and is respecting it at this moment in time. If we run this high, then we have disrespected this fair value gap, which means we have taken away the only bearish argument that we have at that moment in time. If we have taken away the only bearish argument that we have at that moment in time, then that means that we only have bullish arguments. And when we only have bullish arguments, it's very interesting to look at a bullish bias, bullish target to look to buy. So what we see right here is that we never run this high right here. Eventually, when we create a new swing high right there even, we keep sweeping it right there. So the 2 candle rejection right here, first candle is not a rejection, but the second candle is that rejection right there. So we never fully take away this bearish argument. And since we never take away that bearish argument right there, there's never really a reason to start looking at buys. So for example, people looking at this bullish daily fair value gap right here was never interesting to begin with. So can you see how it's a lot more nuanced than it's just an order flow lag right there to continue higher? This is how you can tell a little bit, okay, someone is just trading order flow lags without really understanding it, or someone actually has an understanding of what the arguments are, what the probabilities are, etc., etc. So in fact, what actually happens is we start to even create more bearish arguments and more bearish arguments right there. That leads us to eventually even disrespect this larger fair value area that we have right here, where this right here eventually becomes the target even. So you arguably, at that moment in time, you go from bullish to 50-50 to then bearish, but not immediately bullish bearish. No, because if we, for example, take an EU again, and we look at the recent price action right here, I need you to understand, if you're just starting out with fair value gaps, it can be very tempting to look at every fair value gap and try to short, try to long. This is not what you want to do. So for example, we are currently respecting this bullish fair value area right here. Now we also have quite a lot of bearish momentum coming into the market. So for example, bearish fair value gaps. So at this moment in time, it's actually not interesting to do anything right here. It is only interesting to look, to get involved. If we, for example, run this high, which we are currently not doing, or we are running this low right there. Why? Because if we run this high right here, that means that we have taken away the bearish arguments right there, and we can actually look to continue higher towards these targets potentially. But if we run this low right here, we have taken away the bullish arguments, which means that we can actually start looking at these lows as a target potentially. But at this moment in time, you have bearish and bullish arguments, and when that's the case, again, you remain 50-50. So switching back to recent current live price action on gold right here, we have a very similar situation. We are currently sticking into this bullish fair value area right there that we could potentially continue higher from, but we also have this bearish fair value area, and to be specific, this bearish fair value area going against us. So what are we waiting for? Why don't you look to buy from this bullish fair value gap right there? Because the probabilities right there are not in your favor. You're trying to buy into a bearish argument, essentially right there. So instead, what you want to do is you want to wait until this bearish fair value area is disrespected, because when that is disrespected, we have now taken away the bearish argument. When the overlapping defense is failing, then the last line of defense eventually, so the high is right there, they become the target. And we know it's disrespected by two candle rejection again. So if we run this high, the highs right there, the rejection highs that had a sting into the fair value area, if we run those, then this right here will be a very interesting area to potentially look to buy. Because at that moment in time, arguments are so one-sided right there that it becomes a very clear bias, a very clear target. So your job as a trader is as well to identify those areas and to, in the meantime, simply wait. So this is where a top-down analysis comes in, because a top-down analysis, a lot of traders get it wrong. They think that at every single moment in time, for example, right here on gold, I couldn't really care what is happening right now. All you want to do is you want to set your parameter right there above the high to then potentially look to get involved. Beginner traders, so traders that are earlier in their journey, I used to be the exact same, so it's nothing to worry about, but they lose sleep over thinking, oh, what can potentially happen? What should happen? You need to think less and more so think in, okay, what if, where is the bearish argument getting taken away? So where's the parameter for me to now look to buy? Or where, at what moment can I look to sell? So if we now start doing a little top-down analysis on something that we have already looked at, we'll also do some other top-down analysis on different instruments right here. But starting on gold again. And the reason why gold is because gold at this moment in time is the most interesting to me, the most interesting instrument. If we start on the monthly time frame, that's what you're going to do. You're going to work your way down. Then on the monthly time frame, do we see any specific arguments? So is there bullish fair value gaps? Is there bearish fair value gaps? Well, not really. You could make the argument that we are failing to create a bullish fair value gap right there. But other than that, we have been bullish for a very long time. So I would say the monthly is still in favor to potentially buy. Especially, by the way, quick note in between, if we have an instrument. So for example, the indices also are very similar to this, gold as well, even Bitcoin, for example, cryptocurrency or stocks in general. When you have something that is dealing with all-time highs or even all-time lows, then you just want to find reasons to buy again. An all-time high is such a clear bias. You're never going to get a more clear bias than an all-time high. So let's look for a reason to buy again, through those arguments. So if we now go down into the weekly is where we will get a bit more clear arguments. So for example, we have this bullish order flag. It's a bullish argument right there. We are currently retracing back into the bullish fair value area, which we are somewhat respecting. Another bullish argument. So if we now go into the daily time frame, the only real thing that we have at this moment in time is similar to what we already talked about, is that we have a bearish fair value area going against us. So that's the only real bearish argument that we have. But there's a whole lot of bullish arguments right now. But we still want to wait until this bearish argument is taken away before we start to potentially look to get involved. So that's the top-down analysis. And what you do at that moment in time is, I don't go to bed right now and lose sleep over thinking, oh no, gold, what are you going to do? Are you going to continue higher, continue lower? No, I don't even ask someone. I don't care about anyone's opinion. I care about what the market is going to do. And I care right here more specifically about the parameters. So let me explain parameters, because they are going to transform your trading for the better. Parameters are the areas where an argument is taken away. And when an argument is taken away, that's your time to shine. That's where you are going to potentially buy or sell at that moment in time, because you only have one-sided arguments. So to be more clear, when we have this bearish fair value area right here, it's a bearish argument. We, in order for us to buy right there, we need to take away this bearish argument right there. The way we take away that bearish argument is by running the 2-candle rejection high right there, because then we're not offering fair value. The overlapping defense is failing. We are seeking liquidity at the top right there. So if we run this high, start to create new fair value gaps right there above it, then that right there is your parameter to now start to look for potential entries, for potential buys. So for example, what I do right here is I set my alert above that high. I do it a little bit higher because again, I want a run of the high, not a sweep. I want a run of that high right there to then potentially look to get involved, to continue higher. When we have disrespected that fair value area, again, that means the bearish argument is taken away and we are only left with bullish arguments. So I also need you to understand that a top-down analysis is not for the sake of your ego. So when you are doing your own forecast, it's not for ego purposes or anything like that. No, When you are doing your own forecast or your own top-down analysis, all you are looking for is parameters that allow you to potentially get involved. So where, again, those arguments are one-sided. And either those parameters get met or they don't. For all I care about, what we just looked at on gold right there, if we do start to continue lower right there, I don't care. I might be wrong right there, but my parameter just didn't get met. So if my parameter doesn't get met, I don't look for an entry. That's it. So for example, if we go over the dollar right here and we again set those parameters, then we understand at this moment in time that we have this bullish yearly fair value gap that we might want to continue higher from right there. Now that bullish yearly fair value gap, sticking into that and currently somewhat even respecting it, but it's still early of course, that is a bullish argument right now. Now on the monthly time frame and even on the weekly time frame, we see quite a lot of bearish arguments that we had right there. For example, we had bearish fair value gaps right there that we might want to continue lower from. But these bearish fair value gaps right there, actually the two-candle rejection right there failed. So this fair value gap was taken out, was disrespected. So instead what happens is we trade a little bit higher. On the daily time frame, for example, we trade back into this bearish daily fair value area right there. So since the bearish weekly fair value gap right here was essentially disrespected, you could make the argument we have quite a lot of bullish arguments at that moment in time. So we might be more bullish than we are bearish. But what we see is when we sting into this bearish fair value area, we get such a large rejection from it and we are respecting the bearish fair value area. But at the same time, we're also getting this large candle right here from this tiny fair value gap right there. And that means we now have, on the short term, on the daily right here, we have a bearish argument right here, but we also have a bullish argument. So there's arguments for both sides of the market. This is what we call 50-50 area. Because, and we call this during the forecast, by the way, I'll play a little clip right here. I have a lot of bullish momentum coming into the market right here through this wick, for example, right there. So when it's this battle, that can really only mean one thing at that moment in time when you have momentum on both sides of the market. And that is, of course, a consolidation. Is when you have bearish momentum and bullish momentum right there, that's going to lead to what? A consolidation right there. And that consolidation is because of the fact that we have a bearish argument, but also a bullish argument at that moment in time. So what do we need to do? You mark out the low right here, the two-candle rejection low and the two-candle rejection high right there. If we either run the high or we run the low right there, so we take away either the bearish argument or the bullish argument right there, that right there gives you then a reason eventually to look to get involved. So when reaching this low, you want to run this low, not sweep it like we are potentially seeing right here. No, if we get a second sting below it right there, that's what we would like to see right there to potentially continue lower. Because then we have taken away that bullish argument. And that means that we can potentially look to continue lower. Or on the opposite side, if we run this high right there, and that means that we have taken away the bearish argument. So that means these next PD rays right here that we have, they become super interesting to trade towards. So for example, on the dollar, the parameter is going to be, okay, right there. And also above this high right there, because we are either running the high or running the low. And when those parameters are met, that's exactly when you potentially look to get involved. And that's essentially also what the last step is, when to look for an entry. You look for an entry when those parameters right there are again met. That's when you start looking for an entry. So for example, if we reach this parameter right here, this bullish parameter, then that's where you now want to start looking for a 4-hour fair value gap or 1-hour fair value gap or whatever your entry plan is, to look to get involved. Now, just for a bonus, because I think it's very important, bias is the first step of your trading plan. It's the foundation that we talked about again. But bias is not the only step. Because if the price delivery towards a certain bias is not good enough, it's still not that interesting to look to get involved. Again, I need you to understand, we are not traders right here, especially when I'm talking about the MMT. We're not traders looking to buy or sell every single fair value gap. We are professional traders. We're looking to scale capitals into 6 figures, 7 figures, potentially even future scaling into 8 figures. There's a difference between us and between, for example, the next YouTube guru that you might see that will risk 10% on a singular trade ID. I'm not saying our way is better. I'm just saying our way has proven to allow people to scale into millions of capital. So for example, right here on gold, we talked about, okay, we know that the bias is potentially bearish towards this low right here. Why was that the reason again? Is because of the fact that this fair value area right there was failing. So there were arguably a bit more bearish arguments than bullish arguments. So this becomes the target right there. But does that mean that you should immediately look to profit from that ID? Not necessarily, because the delivery might not be worth it. For example, right here, you'll see that we have a sting into this fair value area right here. And from that fair value area, the two candle rejection is a little bit odd. It's a little bit ugly. This is what we call an ugly two candle rejection. When there's potential signs of consolidations, or it's not according to the rules, not the utopia rules that we have, whereas the first candle rejection, etc., to continue lower, then what happens is that the delivery might not be great. And when the delivery is not great right there, it's not worthing or risking a percentage of your capital on a trade ID like that. It might be worth more to simply wait for price to align bullish again to then continue higher again. Now, I can understand this video is a lot to take in right here. So if you do have the chance, I would highly recommend watching this video maybe twice, maybe next week another time, because this is definitely going to be worth your while. I also have some extra videos, for example, also about the PDRAs and how they give those arguments right there. Link in the description as well. All right, perfect. Thank you.